Hello everyone, this is Intuitive Q. This is the first of a series of 7 short video clips of 6 to 10 minutes about market timing, the finance behind those models, and I will focus on providing some economic intuition of why these market timing models may work, what are good practices, where can it go wrong. So let's start with the first introductory one, which gives us an overview, an agenda of the other videos. Let me share the screen. And then I'll pull up the slides. All right. So market timing models. What I will be talking about are, first of all, why are people so obsessed, so interested in this topic? Obviously, there are some very serious gains to be made. And I will first introduce like a very, very hypothetical situation of a perfect foresight investor, and then try to illustrate actually how much you can make if you had perfect foresight versus just a simple buy and hold. And even if you get like a fraction of it right, it's still a lot of money. So there is some appeal to it just because of the upside that there is trying to time markets. Then I will be talking about different types of market timing. Sorry about that. Different types of market timing. I will first introduce the concept of artificial stupidity. This is an expression introduced by Andrew Law. He's a finance professor at MIT, but he's also a practitioner. He has his own fund. And with this, I will just try to make the case that there is also a downside to market timing. If you try to time markets, there are so many psychological hurdles you have to take. Besides just getting it statistically right, for example, if you are a quant trader, and often case people are actually much better off if they just bought and hold rather than try to time markets. Then I will be talking about different types of market timing. There are myriads of ways to time markets, statistically speaking. For example, quantitative models, they have investment horizons of like seconds in high frequency trading to 1 day, 1 week, a quarter, a year even. And then also like theme-wise, there are ways of viewing valuations in terms of single name securities, whether it's in the equities or fixed income or current FX currencies or commodities, being rich, relatively speaking, or cheap, relatively speaking, and then going those underweight and overweights. So that's like a mean reversion view of market timing, or a contrarian value-based. Then there is a second class of time series trend momentum trades. When a security has been performing well for a certain period of time, let's say 3 months, 6 months, then that security, relatively speaking to, for example, a benchmark or on its own right, is bound to perform well for the next 3 to 6 to 9 months. So there are models out there that try to exploit that, the existence of trend or momentum in the markets. And I will be talking in a second batch of videos about this type of market timing as well. Now, just to manage expectations, a little bit of a disclaimer. I did trade quantitatively in a global macro hedge fund myself. Basically, it was predicting liquidly traded futures and then putting on those positions, going long and short. I will not give away like secrets. I will not give away like very concrete code or like strategies that I implemented and that I know of other people successfully implementing them. So there won't be any like silver bullets. Often case when you implement those models, the devil's always in the details. It's actually very hard. You won't get any secret sauce, but what I will share is good practices. There are some pitfalls and biases and just being aware of them and being mindful of them already helps a lot to be successful, or at least it's a very big first step in the right direction. So what is hindsight bias, for example? What are false positives and false negatives when you look at financial data? So what can we expect here? So this is something that you will that I will be talking about and covering. But outside of that, I will not. So I will share good practices, but I will not give away like very detailed secrets. With that, this is like the overview, and in my next video, I will be talking about the benchmark of buy and hold, and show how that contrasts in its performance to a perfect foresight investor. All right, I'll see you next time.